Hey everyone, welcome back once again to our CA Foundation Business Economics series where we are covering business economic concepts in a short and practical manner. So, without wasting much time, let's get back to the video. So, today we are discussing chapter 6 of business economics, that's determination of national income, in which we will be covering unit 1 national income accounting in this video. So, here comes the Introduction. National income accounting is a method used by governments to measure the economic activity within a country. It provides a quantitative measure of the economic performance of a nation, capturing the value of goods and service produced, income earned, and standard of living. These estimates are essential for policymakers, investors, businesses, and researchers who need to understand economic trends and make informed decisions. So, imagine a national income as the scorecard of a country's economy. Just like how cricket fans look at a scoreboard to see how well their team is doing, economists and policymakers use national income figures to gauge the health of the economy. For example, if India's GDP is growing, it suggests that more goods and services are being produced, more jobs are being created, and overall prosperity is increasing. Here comes first concept or first term from this chapter, gross domestic product, GDP. The total market value of all final goods and services produced in the within a country in a given period. So, using a numerical, it is denoted as above. GDP equals to C plus I plus G plus X minus M, where C denotes consumer spending, I denotes investment, G denotes to government spending, and X minus M denotes to net exports. Net exports means export minus import. So, here is an example. Suppose in a year, India produces rupees 100 trillion worth of goods and service. This amount represents India's GDP. One more example we have where consider an economy where consumer spending is 500 billion, investment that is I is 200 billion, consumer spending is 150 billion, and net exports are 50 billion. So together by using our formula we can compute the GDP as rupees 900 billion. So this is different from the earlier one. Then comes the second concept, GDP deflator. So it's a measure of price inflation calculated by dividing nominal GDP by real GDP and multiplying by 100. So GDP deflator equals to nominal GDP divided by real GDP into 100, which is shown in a calculation manner. So for example, if the nominal GDP is 120 trillion and real GDP is 100 trillion, so we can calculate GDP deflator using above, and which comes to 120. So you might be confused what is real GDP. So we are computing it as above. Real GDP is GDP adjusted for inflation. So it reflects the true value of goods and service at constant prices. So how we calculate real GDP? It is nothing but it's equals to nominal GDP divided by GDP deflator into 100. So it's actually using the earlier formula. I will add one more formula to calculate it later. If the GDP of a country was 100 trillion in 2023 and prices increased by 5% in 2024, the real GDP for 2024 would be calculated at 2023 prices. It means that instead of considering current price, we calculate a constant price for a past year, say for example 2023 in our case. So in our case the real GDP is 100 trillion. Then comes fourth concept, net factor income from abroad, which is shortly called as NFIA. So it's the difference between net income residents receive from abroad, means what we earn, and income paid to foreign residents minus what we paid to abroad. So it is calculated by like above, where NFI would be 5 trillion, that is we income that we have earned by rendering our service or selling our products, less 3 trillion what we paid to foreigners, or what the money we paid to outsiders, then the net would be 2 trillion in our short example. Then comes fifth concept, gross national product, GNP. So what is it? It is the total value of goods and service produced by a country's residents regardless of its location of production. So it is nothing but GDP plus NFI. So here is one more example, we are continuing the above. So here in our case GNP will be 900 billion plus 2 trillion, that's 902 billion. So I think there is numerical error, I will correct it. So just understand it, GNP is nothing but GDP plus NFI, means net factor income from abroad. Then comes sixth one, net national product, NNP at market price. So it's how is calculated, it's GNP, gross national product, minus depreciation, that's the wear and tear of capital goods. So let's say example, if our Indian's GNP is 902 billion and depreciation is 50 billion, so NNP will be 902 minus 50, that's 852 billion. Then comes another concept, GDP at FC, that is GDP at factor cost. So it is calculated by subtracting indirect taxes, where in India it is GST, that is indirectly levied, and adding subsidies to the market price. So GDP at FC will be GDP at market price less indirect taxes and will add subsidies. So if India's GDP at market price is 100 trillion, indirect taxes are 10 trillion and subsidies are 2 trillion, so GDP at FC would be 92 trillion. Then comes one more concept, net domestic product, NDP at FC. So you may see that it would be nothing but GDP at FC minus depreciation. So it would be 92 trillion that we saw earlier, less depreciation of 5 trillion for example, then NDP would be 87 trillion. Then comes per capita income. So what is per capita income? It's the average income earned by a person in a given period. So per capita income is NNP divided by population. So if India's NNP is 852 trillion and the population is 1.3 billion, so per capita income would be rupees 65,538. So it's an average income that a person is earning, which is computed based on the GDP data. Then comes one more interesting concept, personal income. So what is personal income? It's the total income received by individuals like us and households before personal taxes. So personal income is equals to NNP at FC plus transfer payments less retained earnings less corporate tax. So we will be seeing this by example. So suppose if an individual earns rupees 10 lakhs and it receives 2 lakh in social benefit, then the personal income would be 12 lakhs. Then comes disposable income. So disposable income is personal income minus personal taxes. So it's the income that is available for spending or saving. So disposable income means the income can be disposed, can be used for personal purpose. So in our case it would be personal income of 12 lakh less say taxes are of rupees 2 lakh. So disposable income would be 12 lakhs minus 2 lakhs, that is 10 lakhs. Then comes private income. So what is private income? So income received by the private sector including wages, rent, interest and profits before taxes. So it is calculated using above formula. Private income equals to NNP at FC plus transfer payment plus interest on national debt plus corporate profit. So if private sector income is 80 trillion and corporate taxes are 10 trillion, private income would be 70 trillion. So it is nothing, just a basic calculation. Then comes another topic, measurement of national income in India. So national income in India is measured using three primary methods. So first one is value added method or product method. So it measures the national income by adding the value added at each stage of production across sector. So it adds it measures the value added. You add suppose a good or product. Suppose we can consider as suppose say farm goods. So suppose we first buy it from the farmer. So farmer cultivate it, produce it. Then it goes to say primary processing where the cleaning or primary activities happen. Then it goes to factory where further processing happens and it is chopped and some products are being produced using the same. And then comes the packaging unit, it packs the goods. So at each stage there is some value addition done by each of the stakeholder. Similarly, using in we calculate only the value added by at each stage. So here comes our example. So GDP equals to value added by agriculture plus value added by industry plus value added by services. So if the value added by agriculture is 20 trillion, industry is 30 trillion and services is 50 trillion, GDP would be 100 trillion. Then comes income method. So it measures national income by adding up all the incomes earned in the economy, including wages, rent, interest and profit. So it is just so if we are seeing the example, if wages are 40 trillion, rent is 10 trillion, interest is 20 trillion and profit is 30 trillion, national income would be sum of all these, that is 100 trillion. Then comes expenditure method. So it measures national income by adding up all expenditure made up in the economy, including consumption, investment, government spending and net export. So this formula we saw it earlier. So where GDP equals to C plus I plus Z plus X minus M, which will becomes to 100 trillion in our example. Then comes to circular flow of economy. So the circular flow of income. So circular flow of income represents the continuous movement of money between producers, that is firms, and the consumers. So it's a cycle. So one money flows from one end to another, again it flows back to here, again it flows back to here. So household supply factors of production like labor to firms. So they supply labors to the firms, earning income in the form of wages, rent and profits. Then they use this income to purchase goods and service from these firms, which in turn produce more goods and service. So the flow of money, this flow of money helps us to understand how GDP is generated. So the same money is rotated from one place to another, again one place to another, and it keeps on moving. Then comes MG extras. So like every other video, we have a short activity which will help you to understand some of the concepts in a more better and practical manner. So first, MG extras. So create a simple economic model of a small village economy. Estimate the village GDP using the expenditure method. So we have to just understand what are the factors available in a village, what are the crops produced, and what are the earning, spending, and so on. And based on that, you can estimate the GDP of that specific village using expenditure method. Then comes second one, that is calculate your personal disposable income by estimating your income and deducting any taxes. How does it relate to your spending and saving? So how it is impacting your spending and saving, analyze that also. Then comes to the last part, conclusion, where understanding national income is vital for grasping the broader economic picture of the country. The various measures like GDP, GNP and NNP gives us insights into the economic health, living standards and overall prosperity of a nation. So that's it from the video. Thank you. Stay connected. Keep learning, keep growing and keep enjoying. Bye bye.